Okay. I'm going to start with related parties, which is the section at the end, at the end of your study guide, the last section of work. Only because it's really a very small section. Both the sections we're looking at today are disclosure only, you'll be happy to know. Disclosure, presentation and disclosure, but mostly disclosure. In fact, only disclosure. Wrong. Disclosure only. The two sections we're doing today, there are no journal entries, there's no accounting, it's not something we're going to put in any of our statements, it doesn't go in the statement of financial position, it doesn't go in the P&L, it is just disclosure, it's a note, right? So related parties is dealt with in a number of places. We see related parties in Companies Act. I don't know how many of you have done Companies Act, I don't know if you've seen it there, the related parties. We see related parties in the Tax Act too. We see related parties in auditing, in the ISAs. There's actually a standard that deals with how we audit transactions or assess risk on transactions with related parties. So the definition of related parties is the same or consistent with all of these, right? They're all consistent with each other. Let's have a look at what the definition says, and then we'll try and draw a picture and see what we come up with. The definition says, of related parties says, a related party directly or indirectly controls. So a parent and a sub directly or indirectly control. So it could be a sub-sub, isn't it? Those vertical groups that we only control because of the fact that they control and we control them. Okay, so a related party directly or indirectly controls or is controlled by. So it could be, so it's this way, and it's also this way, right? So this parent is a related party. If this is the company you're looking at, they are a related party. If this is the company you're looking at, they are a related party. So both ways, controlled or is controlled by, or is under common control with the entity. So we're looking there at a subsidiary that's this way, because they have common control, isn't it? So a subsidiary that's this way has common control. It's the same company, so they are also related. Has significant influence over. So associates are also part of control. Has joint control, joint ventures, joint operations. Then it says, is an associate of the entity, is a joint venture of the entity. So both of these then, we're looking at, again, the arrows going both ways, isn't it? The arrows going both ways. Here the arrows also go both ways, and there they go both ways. So is an associate or a joint venture, or has significant influence over, or has joint control over. So both directions, isn't it, of the relationship. Is a member of key management personnel of the entity or its parent. So if this is my entity here, here's key management. Key management is defined as people that make decisions in the business. And the reason that they've called those key management and not directors is because in practice sometimes we get people called directors where they actually are, it's just a name. They actually are not on the board of directors. They don't make decisions. Then sometimes you have the opposite. So in South Africa, for example, if you go to an international company, the directors of the company are usually foreigners. So the directors of Coke, there's one local guy as a director. The others are all the guys from the parent, which is in America, right? But who makes the decisions locally? They like to use those terms like president, division president. The division president is not actually a director of the company in South Africa. If we look at who the director is, it's the company secretary. He's one of the directors, or the financial director. The division president, the person in charge of the local division, she's not. So, but she is key management, isn't it? So what we look at when we're looking at key management, we look at the organogram, and when we go up the organogram of the company, we look to see who are the people at the top. And those are key management. So key management of the subsidiary or the parent. So key management here or here would be considered to be related parties, yeah? And then they also say a close member of family of any of the individuals above. So I'm going to do a wife, although I should have done a woman and then put a man, just to be a bit feminist. All right, so there's a wife, and there's little kids. It's starting to look like those stickers on the back of cars. They irritate me, those stickers. Oh, anyway. And there's the kids, right? So it could be a close family member of any of those individuals. Then we broaden it some more, because any of these people, if they have a company that they control, yeah, I'm going to put here a company. If any of these people have a company, and it says that any entity controlled, jointly controlled, or significant influence. So here we're looking at control, joint control, or significant influence. And if you've done groups, you know about these. If you haven't done groups, you don't know yet what these things mean. But you can just take it at face value, isn't it? What it sounds like it means. Those also would be related parties to the company, isn't it? So here's a subsidiary. If the guy, one of the financial directors of the parent, if his wife has a share in a company, that company becomes related parties, isn't it? You can see how broad my picture is getting. It also says that a post-employment benefit plan, so the pension fund of any of these. So here on the side, we're going to put in a cloud, the pension funds. So pension funds of any of these are also considered to be related parties. So you can see that the related parties definition is very, very wide, isn't it? Very wide. So what do they say are not related parties? So they say related parties are not companies that simply have a director in common. So there could be another company sitting over here, company Z, and maybe that same guy here is also a director of company Z. That doesn't matter. Just because you have a director in common doesn't mean, because the director doesn't have ownership. It's just a job, isn't it? Two venturers who share joint control. So here we have a piece of joint control, isn't it? There's somebody else here, the other joint venturer. So this other joint venturer is not a related party. So this one is not, this one is not. Yeah? Providers of finance, trade unions, public utilities, government departments, suppliers, customers, all of those people, there's no link with them in terms of ownership or decision making. Do you agree? So that none of those are related parties. Okay, so once we've identified that we have a related party, we have a requirement to disclose transactions with related parties and balances owing to or by related parties. Here is the example. It should be right almost at the end of your study guide. I don't know, your pages and mine differ. So it's really just a story note. So it says related party transactions. Then it talks about the related parties. But it's not going to go into a story about all the related parties. It's only going to talk about the related parties we have transactions with, isn't it? But it's going to explain why they are considered to be related parties. So if we look here, it says Asgard is related to Wraith, Nox, and Ethesonian. Oh my goodness. These are like what? Greek names, isn't it? Because they are subsidiaries of Asgard. So those ones are subsidiaries, they are related. Asgard is related to Genii because Genii is an associate of Asgard, associates. Mr. Daedalus is a related party because he's part of the key management. Orion is a related party as Mrs. Daedalus, who's the wife of Mr. Daedalus, a key management member of Asgard, has significant influence over Orion. So we're like going broad, right? So those are all the companies that we have that are related to us. We have transactions with them. So the ultimate aim is to disclose the transactions. So then in the beginning, they're just disclosing why they are related, the reason why they're related, and then here are the transactions. So it says, in the past financial year, the following transactions occurred between related parties. We paid accounting fees to Orion. We paid transport to Knox. We paid maintenance to Wraith. We recovered maintenance from a Thessonian. Genii prepared a contract for a lease agreement at no cost. So whether the transactions, remember related party transactions are often not at arm's length, because there's a relationship. So, in auditing, when we look at related party transactions, we always go, oh, fraud or funny business. Okay, so in accounting, even if we didn't get value, we didn't pay for the value we got, we would still put it in. And then outstanding balances included in payables, an amount owed to Knox, included in receivables, an amount owing from Thessonian. If any of these balances had been written off in the year, we would put it in, isn't it? We wrote off an amount owing from a related party. So that's all it is, right? So in big picture accounting, related parties is actually usually more part of groups. And I think because our groups in third year is already so full, they stick it here. But really, when you get to honours, you'll see related parties and even the segments that we're going to look at later today being more part of a groups question. In honours here, the groups is a separate module, and then the rest of accounting is a separate module. Eh? So this stuff is in the groups module, segments and related parties, because that's when we see it. Because you just saw all the words I've been saying are FAC3704 words. Control, joint control, associate, significant influence. Okay. So that's related parties. I was going to say that I've never seen it, but I think there is one exam paper somewhere where it's like for a couple of marks. Either where they just ask you to do the note, but then you're just saying what you've been given, isn't it, and putting it into a note. Or whether they ask you to say whether it's a related party or not. I would say if they ask you for the note, even if you're not sure if it's related, just bang it in, because there's no harm in putting extra information. Obviously, if they ask you to discuss if it is, just try to think of the picture that broadens, isn't it? And remember, the links that we're looking for are some kind of ownership, but ownership where there is influence, isn't it? And that's why we're looking at key management, where there's no ownership, but there's influence. So we have to have influence. Big transactions are not necessarily an indication of influence, isn't it? So just because we only have one supplier or one customer, it doesn't mean that they can tell us what to do. So that's not a related party. Okay, so that's that one. Then we're going to move back, and we're going to look at the first section of work, which is segments. Let me hand out that one. Segment reporting. Segments, once again, is disclosure only. Disclosure only. So, the reason that segments is, as I said to you earlier, more seen in a group scenario is because in a group of companies, you're likely to have companies operating in different industries and in different geographical areas, isn't it? So the purpose of segment reporting is to give our shareholders information regarding risk. The risk that the business or the company is exposed to. And this risk exposure is because the company operates in different industries. So I had a client, for example, that was in the steel business. And then for some reason, one of their subsidiaries was a travel agency. So completely different, chalk and cheese. And then different geographical areas. And that one, is an obvious one. If you do business in Asia, it's different risk to doing business in Africa, to doing business in Europe, to doing business in North America, isn't it? And you would want to know what your exposure is in terms of size, isn't it? Of how much do these different industries and how much do these different geographical areas contribute to the company. Step 1 is to identify your segments. That part is easy. ID segments. Because the way that we identify the segments is we look at what the CEO gets on a monthly basis. What information does the CEO get on a monthly basis? Does he get country by country, all the countries in Africa? Or does he get Africa as one lump, America as one lump, isn't it? That's where we know what our segments are. We look at what the CEO gets and looks at on a monthly basis. That will tell us those are our segments. The CEO gets, like for example, if it's breweries, maybe what they do is they split their different beverages into some kind of different industries. You know that breweries owns a big Coke franchise. ABI, you've seen the ABI trucks? Is owned by breweries. So like that's quite different to beer, isn't it? So maybe they see that as the first segmenting, and then after that maybe they then do geographical, or I don't know. But the segments will be a combination of industries and geography sometimes, or maybe just one or just the other. So step 1 is to identify the segments. We look at what the CEO looks at. Step 2, this is the one that you now get involved with, is to identify the operating segments. I think that's the word. No, reportable segments. I knew that wasn't the word as I was writing it. To identify reportable segments. Reportable segments are exactly that. They're the ones we have to provide information on. They are the ones, these reportable segments, are the ones that we're going to do this disclosure for. Yeah, reportable segments. So, what does the statement say about what is a reportable segment? It has a couple of things it looks at. 4 in total. So it's any one of these where revenue is more than 10% of the total. If the revenue of that segment is more than 10% of the total, it's a reportable segment. If profit or loss is more than 10% of the total, that's a reportable segment. If total assets are more than 10% of the total, that's a segment. So those are the first 3. Or. When we're looking at revenue, I just want to touch on this. We're looking at total segment revenue. It includes inter-segment. Because sometimes you have segments that all they do is sell to each other, but it's still considered to be an important segment, isn't it? So we wouldn't disregard it because the only sales they do is internal or to another company in the group. When you're looking at those big groups, isn't it? We might have a company that all they do is produce for another company in the group, but it's still considered to be a segment. So any revenue bigger than the 10% of the total, including inter-segment revenue, when we look at profit or loss, we do a calc first, and we separate profit from loss. And we say, we don't offset, because do you agree I have lots of different segments? Some may have profits, some may have losses. If I start offsetting, then it starts to go bananas. I take the total profit on its own and look at that, and I take the total loss on its own and look at that. Then I look at the highest one. So here, I will look at the highest one, and then I take 10% of that. And total assets also could have intercompany or interdivisional assets in them. And then number 4 is the catch-all. It's sort of like the NB. Total reportable segments must be bigger than 75% of external revenue. So once I've done 1, 2, and 3, and I add them up, if I don't have enough external, no, it doesn't help. If I don't have enough, I go back and I look for more. Okay, so that's the rule. I first do 1, 2, 3, and I pick up all the segments. Then I look at the ones I've picked up, I add up the revenue for that segment, and I check, okay, what does it add up to? What percentage is it of the total? If I have 75%, then I know I'm good and I've got enough. If I don't have, I've got to pick more. And then how do I pick more? By the highest revenue, isn't it? Because I want to hit that 75. So then I'm just going to pick the highest ones and pick them one by one. All right, so there's an example in your study guide. Example 1. So I'm not sure, mine is on page... It's so funny, I finally found the study guide on the MyUnisa. It's sitting in other resources or something like that, isn't it? It's not sitting in 310. So if you go to MyUnisa and you go to official study material, there's only the TUT letters, nothing else. And then I thought, what the heck? But today I thought I'll go and look in everywhere, and then I found it. All right, so here's the following information that's presented to the CEO. They don't call him the CEO, they call him the chief decision maker, because he has different names, I suppose, in different places. The chief decision maker of H Limited and its subsidiaries, so it's a group of companies, H Limited Group, and this is the segments that CEO gets. He gets segment A through to F, and they've given you the sales, the profit, the loss, the assets. You can see with profit or loss, I haven't said minus and netted. I've kept the profit separate and the loss separate, and I'm going to take the highest of these. So I'm actually going to disregard that one. I'm going to take that one. Okay. So you're going to go through these using those 3 rules: 10% revenue, 10% profit, 10% assets, and you're going to tell me which of those would be reportable segments and which of those are not reportable segments. When you're done, I want you to add up the sales of the reportable segments and make sure it adds up to 75% of the total, which is 9.2 million. Okay. Do you agree? All right, so we look at sales, 9.2 million, 920 is 10%. The two with the that are bigger from that one are C and F. Then, if you look at the wording, it says the absolute profit. So absolute means not netted off, isn't it? So absolute profit. Profit's bigger than loss. 320 is profit. We're looking at anything bigger than 320. F is bigger, C is bigger, and D is bigger. Although they're losses, they're bigger than that 320. Then we look at assets. 5.6 is 560, 10%. So B, C, D, E, and F are all bigger. So when we look at this, we're going to do segment reporting for segments B through F, but not for segment A. Segment A is not considered to be big enough, and so we won't do segment A. Okay, so let's look at what they say in the solution. I presume it's that. Sales 10%. So we get a yes for C and F. Here we get a yes for C, D, F. Here we get a yes for B all the way to F. So reportable, B all the way to F. Okay. Then you're supposed to check if the total sales there. But you can see that, I mean, the only one we're not putting in is this one for 700. So it's clear, I think, that the rest will add up to more than 75%, isn't it? But that would be your final check. I don't know if they do a final check, do they? I don't think so. All right, so once we have established which ones are our reportable segments, we then do disclosure. I don't know why I've put that page on. Is there anything here that I wanted to say? Or it's the continuation of that solution, I think. We do disclosure. So let's have a look at the disclosure. The disclosure starts off, okay, so this is the information. The initial disclosure starts off as being fairly straightforward. That's the example, but I'm going the other way now. Okay, so here's the disclosure. Example 2, if you follow through example 2, you'll see the initial disclosure. So the way the disclosure works is it starts off by talking about what operating segments there are and what reportable operating segments there are, yeah, and how you've determined what these are. So this is just an introductory story, basically. Then we present segment information. The kind of segment information we present is profit before tax, tax, profit after tax. We also present revenue, and we split it between external and between the companies in the group, inter-segment. I don't want to do that. Oh, this one is a bad one. We actually need more than just that. I think that one just had that. I saw all these examples. Oh, this one I remember, Helen. But I wanted to leave one for you to do. I wanted one to show you and one to... Okay, let's look at this one. This one's a big one. Operating segments, identify the segments, and they even go into the products that are provided by each of the segments, right? So here is the story. Okay, then the segment information is this piece. You can see it's a lot more than just what was in the other example, isn't it? So the segment information, profit before tax, tax, profit after tax. External revenue, inter-segment revenue. Then interest, received and paid. Depreciation, assets, liabilities, capital expenditure. Yeah. So you just need to learn the format, right? And then you just need to aggregate numbers to stick into your segment information. Yeah. When we look at, let me see if there's any more. No, it goes straight into recons. When you look at the information given for this segment question, you'll see that they say to you that UTI has 3 divisions, Helen, Plain, and Mirage. Helen and Plain do handbags. Mirage does shoes. We'll end up identifying 2 operating segments, shoes and luggage and handbags. So we're going to have to add these 2 together to get one segment, and then the other one is the other segment, isn't it? So it's just a question of aggregating the information. Okay, and then they will give you the numbers. So these are the numbers for each of the companies in the group, the individual numbers, isn't it? These are the individual numbers for each of the companies in the group and head office. So you're just aggregating, putting it together. Okay, so now what we see, I just want to show you down here. Here is an extract of the financial statements. So somewhere here, we see an extract of the financial statements. So if I just take one number. On the financial statements, revenue is 287,625. 287,625. It's external revenue. Do you agree? Because anything that's intercompany would have eliminated. Okay. When I look at my segment, when I look at what I report for my segment, which is down here, I report external revenue of 345. Do you see there? 345. We can look at some of the other numbers. Profit after tax, 2,899,500. Let's see what's on the previous page. Profit after tax for the group as a whole. One is that number. 24, is that right? 2,458,320. Am I reading it wrong? That's right. So this is, on the financial statements of UTI, this is what they're saying is profit after tax. 2,458,320. But when I look at my segments, what do I show as segment profit after tax? It's a small number, isn't it? Or a completely different number. Segment information, profit after tax, 2,899,500. Okay, so can you see that the numbers that I report for the segment are not tying up to the numbers that I've reported in the financial statements, isn't it? So The second part of segment reporting is a reconciliation. A reconciliation of the segment information to the financial statement information. Let me put that on. All right, so segment reporting then is made up of 3 elements: the identification of the segments, the segment information, info, profit, revenue, interest, assets, liabilities, etc. Yeah. And the third one is reconciliation. Reconciliations between segment total, which will come from there, and financial statements. Okay, so what are going to be these reconciling items between segment total and financial statements? Okay, the first one is a very obvious one. When we were picking segments earlier, we left out segment A. Do you remember that? So the first reconciling item is unreported segments. And head office. Head office will almost never be a reportable segment, isn't it? Oh, it might be, I suppose, I don't know. It's unlikely. They just provide an administrative function. So any numbers related to unreported segments or head office, any profit of the unreported segment or of head office would then need to be adjusted to get me from segment total to financial statements, isn't it? The second step, which is one that students don't normally like, is unrealized profit or intercompany. Let me just say intercompany transactions, and I'll put in unrealized profit in a bracket. It doesn't really matter. Inter-segment transactions. And I'm going to just leave it at that. So, what inter-segment transactions are we talking about? We could be talking about anything. If there are sales between the one and the other, revenue is overstated, isn't it? If there are sales between one and the other and the inventory is still on hand, there's unearned profit in inventory from consolidations module. That's sitting in profit and it's sitting in assets, isn't it? When I prepared group financial statements, I eliminated that. So to balance, I have to eliminate that. If there are loans between the companies, interest between the companies, management fees between the companies, all of those things are going to have been eliminated when I prepared financial statements. Whether the companies were separate companies and I'm doing a group, or whether they were just divisions, isn't it? If they're just divisions of each other, it will also eliminate. So any inter-segment transactions would have eliminated. Okay, so unreported segments, eliminate. Inter-segment transactions, eliminate. Head office, eliminates. Okay, those are the primary eliminations. Let's have a look at the example to have a look at the recon they prepare. So here's a recon, revenue. That's the revenue in my segment. That's the revenue in my financials. The difference is inter-segment revenue. Here's profit. There's the segment profit before tax. There's the financial statements profit before tax. What's making a difference? Unrealized profit in inventory, intercompany transaction. Depreciation and other expenses by head office. Head office costs, isn't it? It's a segment that is not reportable. Tax, the same thing at the bottom. What is it that's reconciling tax? Inter-segment inventory and head office tax once again. Total assets. So there's the total segment assets. There's the assets in the financials. Why are they different? Unrealized profit in inventory is making inventory too big. Must come out. There's a loan between companies in the segment. And then head office's assets aren't there. Yeah. When I look at total liabilities down here, should have that same loan because it would be in liabilities in one and assets in the other. There's the same loan. There's the tax on that inventory because it would have landed up in deferred tax. And there's the head office liabilities. So primarily, your reconciling items between the segment total and the financial statements are these two. Segments that I'm not reporting and inter-segment transactions. Okay, but there's one big one that's missing here that for some reason, we don't see it in the questions that they have in the assignment. But then when you start looking at the exam papers, it's all over the exam papers. And it's got to do with non-cash IFRS adjustments. Okay, so let me explain this to you. Segment reports are primarily cash-based, cash transactions. So when one of the companies in the segment pays rent for an asset, they will just book debit, rent, expense, credit, bank. Yeah. The whole question about is it a finance lease, should I be recognizing an asset, whatever, happens at reporting level, at financial statement level. Do you agree? We do not, when we're doing pure segment reports, worry about IFRS type stuff. If you received money, say, for a government grant, you would just show it as income, isn't it? It's income for you that year. But we know for accounting, we're not allowed to do that. So what we see coming through with segment reports is that we see a story in the question that says that the segments account for the transactions on a cash basis, but that you must then go fix that because financials are not cash basis, isn't it? So we have to look, therefore, at all of the sections of work that we've covered in this module and look at what would be the difference between cash basis and non-cash basis so that I can help you to try and do those recons. Because that's unfortunately where the marks are in the exam. So if we go back to the beginning, I think our first one was government grants, wasn't it? And then we did borrowing costs. And then we did employee benefits, isn't it? But I'm not going to worry so much, I think, about employee benefits. I suppose I can put it in. And then what did we do then? Where did we start leases? We did earnings per share, but earnings per share isn't something, it's just disclosure. Hey, it's not something that's accounting. And then we did leases. Is that pretty much it? Okay, so if I accounted for those things on a cash basis, government grant would be income. Do you agree? Other income, probably. Yeah. Borrowing costs would be an interest expense. Yeah, I would have paid the interest and I would have just expensed it. Employee benefits would also have just been expensed, isn't it? And leases would be either lease income or it would be a rental expense, depending if you're the lessor or the lessee. Do you agree? Okay. When I translate cash accounting into IFRS, the adjustment that I need to make, well, let's talk about what happens in IFRS and then we'll talk about the adjustment. When I talk about IFRS, I know that with government grants, I put it into PPE or I put it into deferred income, isn't it? And then from there, I land up with either depreciation or amort hitting my P&L. When I look at borrowing costs, those also go into PPE. When I look at employee benefits, I land up with provisions that sometimes I need to raise, isn't it? And when I look at leases, I land up with either PPE and a finance lease liability, which lands up being depreciation and interest in my P&L, or I land up with a receivable, which lands up being interest income in my P&L. Yeah. So when you get given segment information, it will be on that basis. And then when we prepare financial statements, it's on this basis. So part of our recon is saying, what was there that was shown as income? What am I showing in my P&L? And I need to adjust. And that's what I would have to do all the way along here. I would have to look at each one and say, what's in my P&L according to cash accounting? What should be in my P&L according to this new basis? And how do I adjust? Yeah, and that's the way that the questions work. Now, I'm sure that the question here, as good as this question is, it doesn't help you at all when you're looking at that, because that's the way they ask it in the exam. So let me just see what they say here. No, they say nothing. Okay, but I think that as a first practice, we must practice one of these before I jump you into those cash stories. So the question is, let me just see, why do I have so much? Oh, because of the solution, and then I've got the red branches are. Okay, here's one that talks about cash basis. I think example 4 didn't. Let me just check example 4 what it says. Photographic equipment, distribution, total sales. Okay. Okay, we're going to look at example 5. It's got a little bit of that cash story in it. So, example 5 in your study guides, I don't know what page it's on. Have you got a page there? 321. 321. Okay, mine's on 325. Sounds about right. Okay, so it says, Red's main operating branches are manufacturing and distribution of toys and children's clothes. The entity identified these 2 reporting branches as the only reportable operating segments. So sometimes they will tell you, these are the ones we've identified, they've already done the work. Head office is not regarded as a separate segment. Red operates only in South Africa. The board of directors is of the opinion that the results, assets and liabilities of the segment should be reported to the CEO on a cash basis, with the exception of depreciation. So they've shown the information on a cash basis, and the only adjustment they've made is that they have put a depreciation charge in. The following is a summary. Revenue, cost of sales, other expenses, depreciation, profit, financial position, there's all the assets, there's liabilities, additional information. The following is an extract from the financial statements of IFRS. So total revenue here is 4920, and it doesn't balance to any of the numbers here, 4920. Do you agree? Something there isn't right. Profit before tax, income tax. So this is the recons. Oh, and I didn't tell you which recons we do, but we do recons for basically all of those. Yeah, so we do recons for, let me just go back using this because it's easier. So these recons that we do here, we do for revenue, we do for profit after tax. It starts with profit before tax, profit after tax. I'm just going to put a profit sign actually. We do revenue, we do profit, we do assets, and we do liabilities. But in the exam, you won't be asked to do all of them, you'll be asked to do one. Yeah? So we do assets, liabilities, profit, and revenue. Okay, so let's have a look at that example 5 again. Oh, there's a lease. Okay. All right, so there's all the information. So they give you that. Then they start to give you the stories. Red entered into a finance lease agreement with Y Limited on the 1st of January. It leases a photocopier and wada. The copier has a residual value at the end of its useful life. and it's a finance lease, right? The only interest paid for the company relates to the lease agreement. So what the company did is they accounted for that, they would have accounted for that as rent. Do you agree? Then it says the company had the following inventory on hand, which it had not yet paid for. That's more non-cash stuff, isn't it? Inventory that I haven't paid for, I haven't accounted for yet, because I don't account for goods until I pay for them. Trade creditors are a certain amount, and trade debtors are a certain amount, and they ask you to do the reconciliation. So they want you to do all of them, all four. Revenues, profit, before and after tax, assets and liabilities. They basically gave you, in this question, the reportable segment information, isn't it? And I mean, if you think about it, unless they're asking you to aggregate things or put things together, there's not a lot of thinking involved in getting this piece of the note done, isn't it? It's just a cut and paste. So the actual work is actually in the recon piece of the note. Okay, so I want you to see if you can try and do that, the reconciliation. It's quite rewarding to do in a way, because you know what you have to reconcile to, isn't it? So you'll know if you're getting it right or not getting it right. But let's start with revenue first. Okay, so let's start with revenue first. This is cash revenue. Cash revenue. So anything that's not cash revenue is not in here. So we have to fix for that. Okay. Let's see if we can reconcile revenue. You're reconciling revenue from 5.3 million to 4920 million. It should be a quick one. Okay? There's no, you know the things that I said to you, we often see the unreportable segments or the non-reportable segments or the unreported segments and the intercompanies. I don't think there's any here. I didn't see any in the question. So for revenue, it's not going to be that. It's all got to do with the cash. Okay, so you're reconciling from 5.3 million to 4920 million. No? Okay, do you agree we have to put changes in debtors and creditors in? Because sales is wrong and cost of sales is wrong, and the inventory that's in transit also needs to go in. So those are the ones that are easy, the easier ones to do, changing debtors, changing creditors, and inventory. That one's a plus 120. This one is a minus 80. And then this one is a plus 175. Agree with that? Yeah, so debtors went up. I didn't account for the non-cash sales, so I've got to increase sales. It increases profit. Creditors went up. I didn't account for the non-cash purchases. It affects cost of sales. Cost of sales will go up. Profit comes down. And I didn't account for inventory on hand at year end. Inventory on hand at year end is a minus to cost of sales. It makes cost of sales smaller and makes profit bigger. Okay, so there's those numbers. Then what did they say to us? They accounted for the lease. The only thing that's in here for the lease is the installment, isn't it? Which is 35,000. That's what they said to you in that little story. They said the only accounting they've done for the lease is they've put the installment in as an expense. It made this number smaller, so I'm going to add it to make it bigger again, to reverse it. Yeah? Then that's what they did. That's the cash entry. What is the accounting entries for a lease? The accounting entries that would land up in the P&L for a lease are depreciation and interest. Okay, so depreciation and interest. Have you got numbers for me? If you go and put those in, that should balance you. You put depreciation and interest in. Depreciation is 100 minus 20 divided by 4. Because there's a residual.
The lease period is the same as the life.
They didn't say what the life was?
Oh, no, sorry.
Yeah. I must say I don't read carefully when I sit and fish now when I go through it with you, but I think I saw that it did say. So profit for the segment 2060, Change debtors, change creditors, change inventory. Then remove the lease installment, put in depreciation and interest. So depreciation is 20, is it? It's 100 less residual of 20 is 80, divide by 4, and that would be an expense. And the interest, if you amort that, is 14,962 or something like that, or 963. But to balance back to what they have, you've got to use a 2. Is it 962? Yeah, I'm just going to use a 2 to balance it exactly to the 8. Otherwise, it balances to 7, but it doesn't matter. It's 2 rand 50, eh? So there's a 50 cents. They round it down, I round it up. Okay, so you can see here, I took out cash and I put in IFRS, accounting rules, to get us from segments which are reporting on cash to financials which report on, okay. Let's see if you can balance the tax. What does it say for tax? And then once you've balanced the tax, obviously then you've balanced profit after tax. If I look at tax, it says tax expense is 576,800. For the segments, and then in the financials it's 637,011. 637,011. So let's see if you can reconcile that. We should be able to take the numbers that we adjusted for accounting, for profit, and adjust them again, isn't it? But now be careful for tax. Tax, the implication of the lease is not that straightforward. Oh, although we have deferred tax, so it should be. That's right, eh? Because tax expense would be a current and deferred tax. So it should be, let's check, 576,800, 637,011. Pretty much if you put in the tax for all of that, that's what it balances to. Is that what you saw as well? So once you've balanced profit before tax, because of deferred tax, the fact that deferred tax makes you account for tax the same as the transactions, then your tax expense lands up being the same, unless there would be exempt items. If any of these were exempt items, that would cause us to be different. But if they're not, if they're just temporary, these are all temporary over here, and those are just normal, isn't it? Then you start at the top with the 576,800 for segments, and you've got to land up on 637,011 for the financials. So if you just take those numbers at 28, if we look at what the difference is there, if you just do it globally like that, the difference there is 215,038. If you times that by 28%, 60219. 211. Is that what it is? Okay, so because of deferred tax and the fact that deferred tax forces you to account for the tax in the same way as the transaction, in the same time, in the same place, then anything that's temporary would get fixed by deferred tax. Anything that's permanent wouldn't. So unless our adjustments were permanent, they wouldn't have affected deferred tax. If we look at their solution, let's just see how they set it up. They start with segment profit, then they put all the adjustments in, the same adjustments. Oh, they bounce them in and out. Yeah, revenue received from other segments, and they've got debtors at beginning, debtors at end, purchases from other segments to balance those two out. We didn't put those in because they go in and they go out, isn't it? creditors in and out, inventory on hand, and then okay, here I would have expected to see the two numbers separate. They've got them as one. Okay, which then lands you on profit before tax, and then for the tax expense, they just put in one group adjustment. So total segment tax expense, the adjustment giving you financials. Okay. Let's try to do assets. Let's see if assets is easier to do. Usually profit is the more difficult one to do. Okay, so assets then. Assets. Assets up here is 1250. Assets down here, 1985. Let's see if you can balance assets. Okay, so we start with 550. We've got to land on 173. Okay, so the obvious ones, the creditors of 320. Then the finance lease liability. It was easy to work out, eh? What did you get? 79,963. 79,963. You add the interest, take off the installment, or otherwise on your amort, whichever way you want to do it. Then I was flummoxed. I thought, okay, I'm balanced. And when I checked, I didn't balance. But I knew exactly, I recognized what I was out by. I was out by 60,211. Where did we see 60,211? Tax. Okay, because obviously when we did the profit piece of the question, the other side of the entries here, the other side of these entries went to assets. That went to assets, that went to liabilities, that went to assets. And then that was just expense, right? So obviously then the tax impact on that goes to liabilities. Otherwise your balance sheet doesn't balance, isn't it? But that's the benefit of being able to reconcile, because then you can check what you're out by, and then when I checked what I was out by, I saw, oh, okay, it's the tax. So what do you think of these recons? They're not fun to do, isn't it? They're not fun to do. Let's analyze some of those past papers. You've got them in front of you to see what the mark allocations are. They almost always ask segments to some extent. So if you look at the October 15 paper, which is the first one that you have there, you'll see that, let's just see what those recons look like. Yeah. Okay, if you look at the October 15 paper, you'll see that segments is included in the first question, which has earnings per share and employee benefits. And when we read the required, we see that it's in a part B. Do you see part B? October 15, question 1B, which was for 10 marks. And they ask you to use the information to disclose the reconciliations for revenue and profit before tax. And I think if we've got a bit of time, we may as well kill this question, but let's just look at the rest, because then this one is done, because we're going to start working on this paper next time. Question 1 in October 15. Then we go to May 15. May 15, it was also in the first question. Do you agree? And it was 9 marks in the May 15. It was question 1, also part B, and it was 9 marks. And they also asked for a reconciliation, but this time they wanted you to reconcile assets. Then the next paper that you have is May 14. May 14, it's in question 2. Question 2, part C, for 11 marks. And it asks you to prepare recon of liabilities, just for liabilities, 11 marks. And I think we can pretty much conclude. We'll look at one more, October 14, which I presume is the next one that's there. 17 marks. Question 2A. Prepare reconciliation for profit for the period. So that one was quite a big one. October 14, 17 marks. Question 2A. Okay. So usually it's not so big. Let me see. And what you almost always see, like if you look at that October 14, if you page back a page, you'll see at the very top in bold, it says cash basis. Do you see? At the top of the first paragraph of that question 2. In bold, cash basis. So your main issue is not going to be the intercompany transactions or the intersegments, isn't it? It's not going to be the segments that aren't there. Your main issue is going to be this cash basis story. And this cash basis story just requires us to like always think, okay, what would have gone in if I was doing cash? And how does it change if I'm now not doing cash, isn't it? But I think if we practice a few, we'll find that we'll be okay. October 15 then, question 1B. If you look at number 4, point number 4 there says the segment report was not prepared on the cash basis, so that one is not cash. Okay, so that one, I think we should practice it quickly. What's the time? We've got half an hour, right? We only need about 15 minutes. You don't need as much time as what the times are on these papers now because it includes the extra hour, isn't it? So they're asking for 2 recons, revenue and profit before tax. Not even tax and after tax, just before tax. If we look, they have 2 divisions, sales and distribution and battery recycling. And there's a head office. So in this one, there's a head office. Whatever there is for head office would not be included in my segment information. The following transactions took place during the financial year. 27% of the revenue of the sales division relates to sales to the battery division for returned batteries. The returned batteries are sold to the battery division at cost plus 5% for industrial batteries and cost plus 8% for domestic batteries. 100% of the inventory was purchased from sales and distribution. 65% of the inventory balance relates to industrial and the balance to domestic. The revenue and profit before tax of recharge for the year was 156,074 and 55,729. So we're reconciling one for one. I actually have this paper. Let me open it. Here. Okay, so here are the numbers we're reconciling. Do a full screen. We're reconciling this profit before tax number, these 2 here, together with this one. And then we're reconciling the 2 revenue numbers, those 2 together with this one. Okay. And if you can do this without drawing a picture, then you deserve a prize. Because it's so confusing, isn't it, that story about who sold to who and what they sold and the percentages and what. So from me, if it's me, I do a picture where on the one side I have the... where's my black pen? On the one side, I'm going to have my sales and distribution division. And on the other side, I'm going to have my battery division. And then I start to understand what's going on in this question. Yeah? Okay. So, 27% of the revenue. me see if I have an alien. Unfortunately not. I don't know. 27% of the revenue of the sales and distribution division relates to the sales batch. Okay. I think it's a mistake. Okay, so let's look at my picture. I must say, I think I'm very visual, which is a disadvantage. We should try, when we're learning, to be balanced, to be auditory and visual and, and doing as well. But I couldn't fathom what they were saying in those two paragraphs without drawing the picture. So S&D, sales to battery, and it's 27% of their revenue is the sales to battery. Do you agree? That's what it said? 20% of S&D's revenue. S&D's revenue is 141 million. 27% of that, 38,070 million, is what they sell to battery. They sell industrial and domestic batteries. Industrial batteries, they sell at a markup of 5% on cost. Domestic at a markup of 8% on cost. And at year-end, battery had inventory on hand of 2855,248. All of that inventory was bought from sales and distribution division. And they then tell you that 65% of that is industrial batteries. So that's this one is then therefore, isn't it? Oops. That one is therefore. So, okay. So that one there is therefore. We then work out the profit piece, eh? So this one is 5 over 105, 8 over 108. Yeah, from groups. So for some of you that are doing groups now, this is like, oh, okay, groups, but what the heck. Some of you that last did it when we did FAC3602, which might have been more than a year ago or whatever, you maybe are going, oh gosh, I can't believe I have to do this again. But that's why I said to you in the beginning of the module that these sections usually appear in groups. So here is the profit pieces, 5 over 105, 8 over 108. It works out to this profit, 162,402. So the profit piece I was able to reconcile easily. I start with the profit for the two divisions. It wasn't very well spelled out because a division is not necessarily a segment. But they do say then, I suppose, extract of the segment report. So I'm assuming that those are two segments and that the head office is not a segment. That's what I've assumed. So I added the two segments. I put in head office and I put in the profit, which is unearned. It must be removed. It's profits from one to the other, but the inventory is still in the group. So minus, plus, it balances perfectly. I've got a smiley face. But then at the top there, I add the two. I get 213,800. I take off the 38 and I get 175,730, which doesn't balance to the number they gave us, which was 156,704. Then I thought, let me check what is the difference that they've got. When I look at the difference between the 213 and the 156, it's 57,726. And when I look at what is that, if that's 20% of a number, what is that number? The number comes out to be 213,800, which is the total sales. So maybe they've either made a mistake when they did the calc, or they've made a mistake in the way they've worded the question. Maybe the question should have said 27% of the total sales is the sale, then it would have worked. Or maybe they made a mistake and then, because they obviously check what it balances to, and that's the number they put in so that it balances, obviously. You happy with that? Okay. Yeah, I don't know. Do you know what happens in the exam? They probably would have marked it right. You would have put that. They would have given you all the marks. The only thing that can happen in an exam with this is that you don't balance, and then you flat spin, and then you spend time that you shouldn't spend trying to fix it. But it all depends how much time you have. Yeah. I think that most of the time, we don't have a lot of time in exams to worry about things that don't balance. Am I right? So we do it. If it doesn't quite balance, we see, oh, can I figure out what it is? Move on. Yeah, move on. Move along. And that's what you would have done in the exam. Now, of course, we want to get a suggested solution, so we're trying to get it to work. Okay, so from next week then, we're going to do the, carry on with this October 15 paper. We're going to then carry on with the beginning of the question. I don't know what was the beginning of the question. Question 1, it's earnings per share and employee benefits. It doesn't sound too bad. We'll work on that. We have to schedule a makeup class for that lecture that we missed. so that you get all your classes for your revision in. This exam, if I'm not mistaken, is early. 9th of May. So we should really do it, we should really do the makeup lecture in the before the end of the month, I think, isn't it? Well, yes, because your exam's the 9th of May. So the options are, today is the 11th? 12th. Okay, so today is 12, which is done. Then we've got 19 and 26, which is the 2 weeks of lectures that we've got going, right? The one alternative is to just make each one of those a bit longer. So that's one alternative. Instead of doing 2 hours next week, we do 3 hours. Or the other alternatives are Thursday. Thursday is at 10 o'clock, 10 a.m. I can do the 21st or the 28th, which is the same week, the Thursday. Or otherwise the Fridays, but you don't like Fridays really, isn't it? Anybody can't make a Thursday? Oh, okay, yeah, I knew that. You said that last time. Otherwise it's Friday, so that's the auditing. Friday is also, Friday I'm down to the 29th because we took the one Friday for FAC3704 for the same reason, wasn't it? Just stay a bit longer? Yeah, it's a long Wednesday. Otherwise we can do it. Is it your first paper? Okay. Then, I mean, the other option is to do it, what is that, next week? 1 to 3rd of May. Or even, I was going to say the 10th, but no. Or any time that week, if you wanted to do it. What day is your exam? It's the 9th. What day is the 9th? Monday. So we can do it later that week or in that week. Would you prefer that? To meet, let's say, on Thursday morning or something like that of that week, which you won't have lectures. And then we can run through what I can do in that last one. If we've worked through the October 15 paper, what we can do in that one is just go through all the sections and say, okay, what are the calcs, what's the disclosure, what must you remember? What are the calcs, what's the disclosure, what must you remember? And do a quick 2 hour zip through. You prefer that? Okay, so what date is that? The 5th of May. Okay. So 5th of May, it's a Thursday morning. What time do you think you want to be here? 9, 8. He likes to be out early. Who is it that likes to be at 8? It's you or him?
Both of us. Next week Friday at 8.
Yeah, you did.
Then I have to wake up the crack of dawn. Yeah, traffic at that.
Okay, so we say the 5th of May, it's a Thursday, because you write on the Monday, yeah? And let's say 9 then. Is that better? I don't think 8 or 8:30 doesn't make a difference, does it? That half an hour I don't think makes a difference. But maybe 9 o'clock will make a difference, because makes a huge difference, yes. If you leave home at 8:30, you'll be here by 9. Whereas if you have to be here by 8:30, you can't leave at 8 because you won't be here. Okay, Thursday the 5th of May. But otherwise I'll see you next week.